Okay, welcome back. Sorry for the interruption, but I was going through the lecture there and looked at the screen and was notified that I had lost my internet connection. So I had to go in, back out, come back out, go back in, and I think I'm live again, or so it has just told me. Okay, we were talking about the reasons for issuing, for not issuing, but for buying your own stock and putting it in the corporate treasury. Those are listed on page 13-11. There's four of them there. Management wants to increase net assets by buying low and selling high. Management wants to support the company's stock price, discussed about how that works. And third, management wants to avoid a takeover by an outside party by reducing the number of outstanding shares that have voting rights. And fourthly, for stock compensation plans to reward employees. Okay. Now, basics. Treasury stock has a normal debit balance. Like I said, it's a contra equity account. It's a reduction of equity. Treasury stock is recorded at cost, what the company paid to acquire those shares, without reference to par value. And then we're going to show that how they handle that in the next couple pages. And the treasury stock account is reported beneath retained earnings on the balance sheet. And they'll show an excerpt of that, I hope. Something just else popped up on the screen. Okay. Treasury stock decreases the number of shares that are outstanding. Hence, they don't get dividends and you can't pay yourself. Okay. Outstanding stock is issued stock less the treasury stock. That would be the number of shares outstanding. Only outstanding shares have voting rights and receive cash or stock dividends. Treasury stock does not carry a vote and it receives no cash or stock dividends. The purchase of treasury stock. Again, hours it cost. So, assume that on March 31, Smart Text Lending purchased 1,000 shares of previously issued common stock, paying $5 a share. $5 times 1,000 shares would be $5,000. So treasury stock gets debited for $5,000 and cash gets credited. Okay. Let me page just flip forward 2 pages. Can't turn the page. Sale of treasury stock. If you sell it at cost, let's say they assume that they sold 100 shares of the shares they bought, and they sold it for $5. No problem. You just get the cash, 100 shares times $5, and you credit treasury stock, $5 times the 100 shares. Now, if you sell it above cost, what happens? Well, let's see here. If it is sold for more than cost, the difference is credited to a new stockholders' equity called in paid-in capital from treasury stock. Okay. So that's going to increase the assets of the company. So it benefits the other shareholders. But we have to keep this paid-in capital account separate. We have to call it paid-in capital from treasury stock, because if we sell it, if certain other things happen, we're going to take it out of that paid-in capital treasury stock account. Okay, say they sold 200 of its treasury shares for $6. Well, that's above cost. Okay, so they show you there. It brings in cash of $1,200. We reduced the treasury stock by what we paid for it, $5. Okay. 200 shares times $5, 1,000. So the difference of $200 is a credit. Hold on. Yeah. Who's calling? No, she's not here. She's not here. Sorry for the interruption, but people didn't know I was busy when they called. All right. So the difference between the $1,200 we get from selling it for $1 more than we bought it back at, I always credit it on the price we paid for it, and the $200 difference is paid in capital from treasury stock. And it's very important to keep that separate, paid in capital account from treasury stock transaction, because if certain other things happen, it's going to come from that account first. Here we have one sales price on the treasury stock below cost. So we paid $5 for it. Now we're selling it for $4.30. So it brings in $860. We always credit it for what we paid for it. Account for treasury stock at cash with the treasury stock account. Treasury stock is going to go up or down, debit or credit, based on what we paid for it. And it gets a little crazy if we have multiple purchases of it at different prices. I don't think they show that here, but it can happen. So the paid in capital account is debited. The paid in capital from treasury stock is debited for the difference here of 140. That's why we had to keep that paid in capital in excess in a separate treasury, designated as coming from paid in capital, coming from my sales of treasury stock above cost. All right. Explain that there. Now what happens if Smart Touch Lending sells an additional 200 shares for $450 each? All right. Well, 450 times 200 would be the $900 cash coming in. Paid in capital from treasury stock only has $60 left in it. So that is used first to make up the deficit between our cost basis, $5 a share, and $450, the 50 cents per share, is going to be $100 difference. But we only have $60 in the capital, paid in capital from treasury stock account. So we use that all up. Any amount remaining is charged against retained earnings. So we debit retained earnings for the balance of $40 in this example. Okay. And they say that only $60 remained in the paid in capital from treasury stock transactions. The difference, $40 debited to retained earnings. Okay. Then they show you how it's reported. Treasury stock on the balance sheet there in figure exhibit 13-7. Preferred stock shown first with its paid in capital. Common stock showed a second with its paid in capital. Then we have total paid in capital. We have retained earnings, and then we subtract the treasury stock from what's left from the retained earning, from the balance then. And then we have total stockholders' equity. Retirement of stock, a little bit different than treasury. Treasury stock we buy and we may reissue, resell it. If we're canceling it, we're going to retire it, and it's canceled. Okay. Retirements of preferred stock are common as companies seek to avoid paying preferred dividends. It may exchange them for common stock or just retire it. And it removes the stock is removed from the company's books. So, give us an example here. Okay. Turn 2 pages. How are dividends and stock splits accounted for? Well, cash dividends, we've seen that already. And cash dividends cause a decrease in both assets and equity. Well, it'd have to, because of the equation. So whatever you're paying the dividends, usually in cash, it could be other assets, and a equity account, retained earnings, is debited. So the assets being distributed, cash or whatever, are credited. Most companies prohibit using paid in capital for dividends. Most, I thought it was all, but I'll go with them. Accounts refer to the term legal capital to refer to the portion of stockholders' equity that cannot be used for dividends, only retained earnings. So we have a couple dates here that are important. Declaration date, that's a date the board of directors announces the dividend and makes it official. Date of record, that is the date by who we determine who gets it. Because stocks are exchanged daily, multiple times a day on the stock exchange. So the declaration date, who owns it on that date, is the person that is going to get the dividend. The payment date, it will be subsequent to that, but that'll be the date when the payment is actually distributed. The dividend is distributed. So when they declare and pay the dividends, how do we account for that? So May 1, they declared the dividends of a nickel a share on 22,700 outstanding shares. 23,000 were issued, less the 300 that are in the treasury. So we're only dealing with the outstanding ones. Treasury shares do not get a dividend. So 22,700 times a nickel is $1,135. And then dividends payable. They haven't been paid yet. Okay, this is a declaration. The date of record, we do to pay the dividends. Dividends payable is debited, and the cash is credited for the $1,135. And then at the end of the accounting period, the retained earnings gets debited, cash dividends get credited. How do you do it on preferred stock? Well, it's usually as a percentage of the par value. And I give you an example there. Now, notice that one paragraph with the highlighted amounts in it. Cumulative preferred stock and non-cumulative preferred stock. If a preferred stock dividend is not declared by the board of directors, if it's a cumulative preferred stock, any non-paid preferred dividend accumulates. So when they do pay it, and they have to pay it before they pay any common dividends, it's cumulative. So if 2 years go by, 7%, and it was $10 or $10 dividend, you got to pay, and after 2 years, you'd have to pay $20 to the preferred shareholders before you pay any common dividend. If it's non-cumulative preferred stock, any preferred dividend that is passed, that is not authorized by the board of directors, formal action, it goes by the wayside. It's water over the dam. You don't have to pay it up. It's a missed dividend. If you have cumulative preferred stock that has not had a dividend payment, it's called dividends in arrears, and they have to be paid again before any other cash dividends are paid to common shareholders. They have also, I don't know if they talked to it here, if it's coming up, there's called participating preferred and non-participating preferred. If it's participating preferred stock, they get their preferred dividend, and then they share anything else with the common shareholders if they get a dividend. Okay, if it's non-participating, they only get the preferred dividend. They don't get anything else. Stock dividends. Stock dividends only affect stockholders' equity account. So what is a stock dividend? That's when a corporation distributes its own shares to shareholders. Ask yourself, do any assets or liability accounts change? No. All we're doing are giving additional shares to the existing shareholders in the form of a stock dividend. So what it is it's a rearrangement of the equity accounts. What we're doing, we're taking something out of retained earnings and putting it into common stock and paid-in capital in excess of par. They have no effect on total equity. The composition of equity has changed, taking it from one equity account, putting it into another. They does not have any effect on assets or liabilities. So there is no increase or decrease in wealth or size of the corporation. So how can there be anything given to the shareholders? Well, this is it. Now, here's the rub. If you like pizza, let's think of pizza. And I go back to one of my favorite philosophers of the last century, Mr. Lawrence Yogi Berra, the baseball player. He walked into a pizza shop one time and asked the guy for a medium pie. And the pizza shop owner said, how many slices do you want me to cut it into, 6 or 8? And Yogi said, you better make it 6. I don't think I can eat 8. Well, it doesn't matter because it's a medium pie, 14-inch, 16-inch pie, whatever. Does it matter how many slices you have? If you have more slices, you have smaller slices, but the pie is still a medium pie. It's not bigger or smaller than, it's not a small pie, it's not a large pie, it's not an extra large. It's still a medium pie. So if you own shares and you own 5% of the shares outstanding and there's a dividend, all the shareholders get this proportion of the dividend in the proportion of their ownership percentage. So your ownership, if you own 5% and they give you another 10 shares, you don't owe 11% now. You still own 10%. The only thing is that 10% ownership is now represented by a larger number of shares. And same thing with all your fellow shareholders. Their ownership percentage doesn't change. It's just that what they own is now represented by more shares. So what happens there, you just reduce retained earnings and increase common stock and possibly paid-in capital in excess of par. Okay. Why issue stock dividends? To continue dividends but conserve cash. It's sort of almost like a smoke and mirror thing. To reduce the market price per share of its stock, well, you have more shares outstanding, supply and demand, it's going to push the price down. To reward investors. Often investors feel like they receive something of value when they get a stock dividend. Well, if they do that, they're not very smart because what did they get? They got nothing. They got more shares, but they didn't increase their wealth at all. So as I said, the market value would go down proportionately. So does it matter? Let's say you have $100 invested in 10 shares of $10 stock, and they make a stock dividend. Okay, so now let's say 10 shares. Let's say they double, they give you 20 shares. Your investment is still $100. And when it was $10, when you had a $10 share for $100, you own whatever percent, it doesn't matter. Trying to do this off the top of my head without a piece of paper. Please bear with me. So they give you more shares. Okay, let's say they give you 2 shares. They give you 5% stock dividend. So you get 2 more shares. You now have 12 shares. Your investment is still $100. So your shares are now worth $8.50 or $8.25 a piece instead of $10 a piece. You have more shares, but their value is lower. You still own whatever percent of the company you owned before, just that now you have 12 shares instead of 10 shares, and the value of those shares is exactly the same as what it was when you owned 10. So again, a little bit of a smoke and mirror. Again, you want the declaration date, the date of record distribution date. Has an impact on things. Now, they say there's a small stock dividend, and a large stock dividend. They're not talking about the size of the company. They're talking about the size of the dividend. Usually, if it's between or less than 20 to 25%, it's called a small stock dividend. If it's greater than that amount, and again, you can see there's a problem in this area if they give you a range, 20 to 25%. If it's more than that, it's considered a large stock dividend. So small stock dividends are accounted for at the stock market value. Okay. Now the company had to get them somewhere, whether it's treasury stock or buy them in the market to give them to you. Okay. It's the common stock dividend distributable is credited for the dividend's par value, and the paid-in capital is credited for any difference. Okay. And after the journal entry, they show you what the T accounts look like. All this is a rearrangement of the amounts between equity accounts. Basically, what they're doing is they're reducing the amount available for payment and dividends because they're reducing retained earnings. See, like any other dividend, it's coming out of retained earnings. Oh, no, it's not coming out of retained earnings because it's just switching it around. Large dividends are rare, but when they're declared, they're normally accounted for by the stock's par value. The other one was their market value. Okay, that's the only difference. And the same thing with the large dividend. You still have your same ownership percentage, and you still have your same net investment when you bought the stock. So the only thing now is you own 150 shares instead of 100 shares, but it's still worth $10,000 and still worth 1% of the company. Yeah, again, a little bit of smoke. I don't want to say smoke and mirrors. That maybe give it the wrong connotation. All it is, they're taking things in the equity section of the balance sheet, the equity accounts, and they're moving things from one equity account to another equity account. Okay. Stock splits. Fundamentally different from a stock dividend. Stock split increases the number of shares issued and outstanding, or a stock split also increases or also decreases the par value. So usually it's given as a ratio 2-to-1, 3-to-1. So if it's a 2-to-1, if you get one share for every share you own. So if you had 10 shares and a 2-to-1, you now have 20 shares. If it's a 3-to-1 split, you now have 30 shares if you own 10. If you get, you have 3 after the split for every one you own prior to the split, whatever the ratio is. Now, the thing is, if you have a 2-for-1 split, it's going to increase the number of shares by doubling them. It's going to decrease the par value and the market value by half. Okay. A stock split also decreases the market value. Okay. So a stock split, a 2-for-1 with a $2 par and $20 market value will result in 2 shares of $1 par and a $10 market value. A stock split, like any other stock issuance, cannot involve issuing more shares of stock than authorized in the corporate charter. Okay, it's understood though if you have a split, you're going to adjust the authorized number. Okay. They give you an example there. Assume that the common stock has market value 50. They wish to decrease it to 25 per share. And affecting a 2-for-1 split will do that. So you double the number of shares, cut the par in half, and cut the market value in half. Assume Greg Skames has 3,150,000 shares issued outstanding. After that, they would have twice that amount, 6,300,000, and the par value would go from $1 to 50 cents. Okay. Again, the total equity is not affected. All you do is put a memorandum entry in the ledger and note that you had this event. Cash dividends, stock dividends, and stock split. Exhibit 13-9 does a very good job of summarizing them. What the effect is on total assets, total liabilities, common stock, paid in excess of par, and retained earnings. Notice the stock split, no effect on anything. Large dividend, no effect on paid in capital or total stockholders' equity or assets or liabilities. It just increases the common stock and decreases retained earnings. Small stock dividend increases the number of shares, increases the paid in capital in excess par, decreases retained earnings. So that's where it's coming out of retained earnings. No effect on assets, liabilities, or total equity. It does affect the composition of equity. Cash dividend decreases assets, no effect on liabilities, no effect on common stock, no effect on paid in capital in excess of par, decreases retained earnings because that's where they come from, and hence a decrease in total equity. All right, then they show you, I don't want this. They show you how's the corporate income statement prepared. The only thing here, it's like we've saw before, but now the thing is on the bottom, we want to do a earnings per share. You can see that earnings per share in exhibit, let me go up here. Exhibit 13-10, you have a income statement that looks like all the other income statements we were doing this semester, but on the bottom there's a new four lines. Earnings per share of common stock, and that's 20,000 shares outstanding. You have income from continuing operations, and that would be that number divided by the 20,000 shares, 356, and income from discontinued operations, $1.38. That would be that number divided by the 20,000 shares. Then you have net income, total net income, 98,750 divided by 20,000 shares, 494. It shows you how much each share, how much was earned in each category there from operating income, from discontinued operation, and in total. Investors use that, stock analysts use it to gauge how the company is doing. Again, you have two companies in the computer. You have Dell and Apple. Well, Apple's not a computer company, it's a phone company. Say you take Ford and General Motors, different companies, different size assets, all that. Well, one of the things you want to look at is what's the earnings per share for each of them. Okay, it could help you determine which one you want to invest in. I'll give you an example there with Kevin's Vintage Guitars. And discontinued operations are always shown separate decisions, and we're letting people know that this operation, General Motors did it years ago with Pontiac. They discontinued those parts of their 5 or 6 different labels, and Chevrolet, Pontiac, Oldsmobile, Cadillac. They're just down to Chevrolet, Cadillac, and GMC now. Well, they had GMC before too. So you want to show this separate to alert the user that this part of the company is not going to exist after it's discontinued, and you show the income from it separately, and you show the gain or loss on it separately, net of the tax effect. And they talk about earnings per share. It's calculated. Again, there's more to it than here, and you'll get that in intermediate accounting if you're an accounting major or interested in it. They do it fully diluted, and it's, again, earnings per common share. Most widely used statistic, and it's only outstanding common. Earnings per share is calculated as net income minus preferred dividends divided by the weighted average of the number of shares outstanding. That's a hard number. It was for publicly traded company to determine because their shares trading all the time. Well, if they're outstanding, no problem. If they're treasury stock, you'll have to do some computations. Preferred dividends are subtracted from net income because preferred stockholders have the first claim out to the dividends. Therefore, the portion of the company's earnings is not available to common stockholders. Okay. Companies that report discontinued operations must report earnings for those discontinued operations separately, either on the face of the income statement or in the notes of the financial statement, and then the tax effect, the gain or loss on the discontinued segment. Page to turn here. How is equity reported on the balance sheet? Now we have, it's a little bit more complicated than we saw at the beginning of the year, as well. We have preferred stock, and it's paid in capital, common stock, and it's paid in capital, and treasury retained earnings, and then reduced for any treasury stock. Okay. And then they have the statement of retained earnings. We've seen that. Now, sometimes there's what we call an appropriation of retained earnings. Retained earnings that the board of directors designates as not being available for payment of dividends because they want to use it to research and development of a new product or expand the plant or warehouse or something. Okay, they're restricted. They may appropriate for a portion for a specific use designated, and they would do so. And it would just be a memo entry. Occasionally, a company will have to make finds an error from previous periods, prior period adjustment. That would be handled as a adjustment to retained earnings. You can see it there in Exhibit 13-12. Retained earnings, beginning of the period, adjustment for a mistake that you discovered this year from prior years. And then you have an adjusted, then you have net income less dividends and retained earnings at the end of the year. Statement of stockholders' equity. Sometimes you'll have this available for people. It can show a more detailed description of what happened to equity accounts during the year than what is on the equity section of the balance sheet. Again, this would be showed in the notes to the financial statements, not on the face of the statement. Put too much information out there, there's a tendency that some people may be confused by it. How do we use stockholders' equity ratios to evaluate business? Again, we have the earnings per share number, and we also have the what's the other one? Times the PE multiple, price earnings ratio, PE multiple it's called, was the market price of the share divided by the earnings per share. So you have to do the earnings per share first, and that's an abstract number, and that gets you got to be careful with that statistic because it gets a little distorted. If the market is overheated or underheated, you can get some distortion there. Again, people now are looking at stocks and say, hey, stocks never had PE multiples, price earnings ratios this high. Well, the stock market has never been this high. As the price goes up, the multiple is going to react accordingly. So you have to temper that with, you have to be aware of what's happening in the economy and what's happening in the market. Again, ratios are very, very dangerous things to work with. They're very useful things to work with, but we have to temper them. Never, ever look at just one ratio alone. And not only that, but when you look at a ratio, don't look at just the ratio. Look at the numbers that go into it. Rate of return on stockholders, net income minus preferred dividends, that divided by average common stock price or equity. Come on. Average common stockholders' equity, beginning end of year divided by 2. Divide that into the net income less the preferred dividends, and you get a ratio called the rate of return on common equity. We had rate of returns on assets. Now this is on equity. And again, if the company is highly leveraged, that company number is going to be lower. So again, be very attentive to other things. Don't focus. Use the ratios, but don't focus on the ratios alone. You have to look past the ratio number. You got to look at what goes into its computation and take it with a good understanding of what went into the numbers that made that calculation for that ratio. So that brings it to the end of the chapter, review things you should know. I'll do another tape going over the solutions for the assignments if there were assignments on the syllabus. If not, this is it for the semester. Thank you for all the work you've done. Hopefully you are more knowledgeable now than you were back in January. And I know from the test score, some of you are. Definitely, some of you, it might be a maybe. One thing about the course, whether you loved it or hated it or were indifferent, I think it is something that could be valuable the rest of your lives, not only in your professional careers, but in your personal life. Start thinking in things in terms of assets and liabilities. Is this going to be something that benefits me, an asset, or something that harms me, a liability? And again, maybe harmed isn't the right word. Something that is not as desirable as an asset. Let's put it that way. Think of things in terms of that. Is it good to go into debt? Well, yeah, if you're going to buy a house, you got an education because that house is going to provide you a place to live, protect you from the elements. Education is going to make your life more interesting and probably more profitable for you. And Again, education is a wonderful thing. Whether you use it professionally or not, just in other aspects of life, there are people that aren't aware of the things that you are aware of. And if they're not aware, if an individual is not aware of something, how can they take delight in it? How can they treasure it as something good? Um, I threw a couple jokes in throughout the semester. Hopefully, I like jokes that are for the thinking person, jokes that some people don't get. It's over their head. Make you think. Okay, so that's it for the Accounting 101, except for the shell outline. PowerPoints will be coming out along with this email and then the final exam. Thank you for, again, all the work you did and the attention you devoted to the study of Accounting 101.